We're going to stick with bonds, and we'll do a little myth busting. This is something that's always gets people going here. There's a common misconception out there that volatility in bonds could spark contagion in the underlying market. So, Chris, you know the idea. The ETF haters out there, they think there's going to be some giant contagion because you've got some funds that invest in somewhat thinly traded bonds. So, floating rate bonds, for example, and that if there's ever a period where you are selling those bonds, those ETFs, and you need to sell the underlying, there's not sufficient liquidity, and somehow this could cause a mess. How do you address that?
Well, I think we've been tested, right? There are very active fixed income ETFs in the market today, and we've seen some disruption in our equity markets that have bled over into the fixed income market. October of 2018 is a perfect example. Big drawdowns across all ETFs, both equities and fixed income. And we didn't see a dislocation in the market, the underlying market. So I do think the myth is out there. Maybe we haven't tested it fully. We haven't seen the true black swan. But we've had some pretty harsh tests of the system as it stands.
That's the way I feel. Kevin, you own an ETF family. Do you have concerns about underlying liquidity of ETFs that are out there?
No, but I don't do a lot of small cap ETFs. I'm always worried that if someone wants to put 100 million or 200 million in, I don't want to move it more than a penny. And if the underlying issue is large cap, domestic, S&P 500 companies, you don't have that problem. Where you have that problem is in very eclectic credit markets of a single C, a double C credit. There's no liquidity. That trades by appointment, and that's why I think the fixed income ETF market has a ways to go. I'd like to see an ETF that actually has actively managed rules that say liquidity is one of the metrics by which you decide what the underlyings are.
So can electronic trading deal with this problem? You have to trade by appointment. Is there any way to increase liquidity using electronic trading?
Well, what's great about electronic trading, it creates data. And the data that we have now actually shows what the liquidity in the market is. And so we are putting out data daily in real time where you can look at what the liquidity in a given bond instrument is. And these applies to global bonds. So it's actually a way that we can create some smart indexing based on the liquidity in the underlying.
My problem with this whole argument, Tim, is we had this crisis. We've had several crises in the last several years. What do you want in the fourth quarter? If that wasn't a crisis in December, my heavens, if that market wasn't tested then and we got out of it, is there something wrong with that theory, though? Is there something we're missing?
Look, less liquid markets are going to gap out. And I'm an emerging markets guy. And I used to call this the ETFization of my markets, because if I'm trading Brazil and I've got second-tier Brazilian stocks at a billion market cap, but suddenly people are throwing around the EWZ as a hedge overall for their portfolio, these stocks that are 50 bips in this portfolio are going to get thrown around. The same thing goes on in credit. So I don't think you can replicate the underlying dynamics. If a market's illiquid, it's illiquid. And I think that's where the confusion lies. The ETF's not going to solve that problem.
That's exactly my point. If people want to sell, they're going to sell. They'll find an ETF to do it. They'll find a way to get on the floor. They'll throw a rock at someone, say, take whatever I've got. If
throwing rocks at Kevin.
Want to sell, they're going to find a way to sell. An ETF is a vehicle. Mutual fund is a vehicle. Brokers on the floor are different vehicles. Don't get me started. We'll go crazy.